All right, guys, what's going on? This is Ryan with Blockroot, and I promised you, I believe it was yesterday, that I would give you something that should help you be a little bit more comfortable, all right, in the market, or in certain cases, actually getting out of the market, okay? So this is a really effective way, okay, to pretty much take any type of long-term spot trade, position trade, investment, or what have you. Okay, this is a higher time frame application. All right, so with your spot holdings, okay, if you don't want to expose your spot holdings, all right, to all of the downside that might come with, move like we had last night, okay, what you can do is use some type of, as I've mentioned this before, some type of volatility stop. Now, when you're using some type of stop or exit strategy that's based on, a volatility stop or the average true range or a moving average, okay, using this systematically, all right, is going to imply that you are going to miss some parts where price does move, upwards, and you're not in the position yet because, your signal has not been given. So you can add a certain amount of discretion and really try to, add your own nuances to this so that you can have better entry signals. But as far as finding a way, or rather using a specific systematic method to exiting your positions, something like a 14 EMA and 20 moving average crossover is one, thoroughly back tested and extremely successful on something like the 4-hour and the daily. So what this is basically it's a moving average crossover strategy using an EMA, okay, which is more sensitive, and a moving average, which is less sensitive. It's just the, like I said, it's the arithmetic mean, or it's just the standard average. And in this case, we're using a 14 EMA, okay, and then a 20 moving average. So the center Bollinger line again. So with this, okay, the same way that we use the center Bollinger line or the 20 moving average, okay, on the higher time frame to distinguish, who's in control. Okay, so when we're above the 20 moving average, which is this red line right here. All right, I'll just take this off for a second so you can see when we're above this moving average. All right, the bulls are control. When we're below it, the bears are control. And you see how this more or less, okay, has us in the market, all right, for a majority of the trend and out for, a decent amount of the drawdown. Okay, so as you can see over here, we are quite extended above the 20. Even this drawdown, we were in it, all right, but it didn't give us a signal to get out. All right, the signal to give out wasn't given until all the way up here. So nevertheless, you have to remember it's a moving average, so it's going to lag. That means you're not going to get this signal until prices actually moved past it. All right, so it does have that that little bit of that window that exists between when the signal is given or when you see the signal and when you can actually enter based on it or exit based on it. So this is just the 20 moving average. And if we apply this on the higher time frame chart, something like a daily, 12, 6, 4-hour, okay, this can give us a little bit more confidence, okay, in stepping in the market and, being a little bit more confident about what type of trend we're in. So when we're above this, okay, we could be a little bit more certain that we are, in bullish conditions, all right, price is moving up, it's above the 20 moving average. Now I apply the 14 EMA, okay, because this adds the extra sensitivity of the more recent price action. Okay, so now you can see once I've added the 14 EMA, okay, this gives us a better entry signal. All right, we don't have to wait till price moves up here. Okay, we have an entry signal down here, so mind you, this would likely occur right here. All right, and entry signal over here, mind you, you're probably going to get in right here. Okay, exit signals up here. More or less, what you can see is that you capture the bulk of the actual move. So here, out over here, all right, you have a bit more, a bit more confidence, okay, and it's not that you actually have to use this method to get in and out, but you can use this as a first set of criteria, all right, that you will use if you want to be in the market, or in this case where we've had a recent drop where you will immediately get out of the market. So in the case of getting out, what you'll use is not just the 20 crossover, you can actually use something like just the 14, okay, on the daily. So using the 14 EMA on the daily, all right, so right here, let me turn off the 20. Okay, now you can see that just using the 14 on the daily, okay, we are out for a good amount of the drop, all right, we pass right through, you could exit, okay, mind you that you're going to have some false signals, but you can see over here, all right, spend a good amount of time out under it, all right, close above it again, that would be a signal to enter long. All right, fall below over here, and that's a signal to get out. Now, if you just start applying this strategy, today, okay, you have to understand that moving forward, you could experience, just the way that certain things happen in clusters, you could experience, the next few moves being the moves that are chop, meaning where you enter or exit based on this and you get chopped up. So you have to understand that when you're trading and you're trading based on a system or a strategy, okay, when it has positive expectancy, all right, when it's been tested and it's proven that it does apply, okay, successfully, you have to understand that there are going to be periods where it is unsuccessful. And the idea is that you take enough trades to see how the success plays out in the long term. Mind you, there are periods where you're going to get chopped up, it's going to give you false signals, it's going to give you failed trades, and this is going to be where you're going to need to apply that extra little bit of discretion, okay, to either get in the trade or get out of the trade. So as I always say, you're going to want to, all right, pay attention to more than just one clue. But this can be something that you use where you say, okay, I know that when we are above the 14 EMA and the 20 moving average, okay, that we're in a bullish trend, all right, I could look to buy pullbacks, all right. Anything below it, what happens is when you fall below these levels, okay, we could see that when we fall below these levels, this is where the market starts ranging, okay. So I will often say that I will use, all right, about 2 to 3 different strategies when I am trading, okay, and I need to know what type of market condition I'm in to determine, how I'm going to go about trading. So I will trade ranges based on supply and demand, okay, based on, you've seen me use the volume profile and the cumulative volume delta, all right, when I'm trying to identify, how price is reacting at support, or in that case demand, and how it's reacting at supply or resistance. So I have to be able to understand, though, when it is important, okay, to apply that specific strategy and if the market condition calls for it. Now, when we're in a really strong trend and we're above the moving average, I might use something, all right, a little bit less based around structural, the structural entries that I would use for a range-bound portion of the market, and I might use more of a moving average, high speed, shorter moving average method, all right, and try to pick up a little bit more on price action, okay, then trying to immediately predict where the next top or where the next resistance is, or rather where the next resistance or where the next support is, especially when you get into portions of price action where we are more or less, okay, not in no man's zone where there's no historical, lines in the sand to refer to, but when you're making a new high, okay, and you don't have any other structure to base any kind of, you can't extrapolate any type of resistance off of that, you have to use something like a momentum indicator, or you have to use, whether or not you're going to be looking for topping candles or whatever method you're using, okay, nevertheless, until you actually establish a resistance with one solid touch, there's really no way to go about trying to predict where that's going to occur, because you can see plenty of times when we're moving up, okay, we will have certain, pushes based on sellers, all right, and then we'll just pass right through anyway. And what you don't want to do is start trying to predict which is going to be the ultimate top, all right, before price corrects to a degree. So using this moving average, all right, this 14 moving average, okay, or the 14 and the 20, so it's the 14 EMA and the 20 moving average, okay, this is similar to a volatility stop. So when we're below it, okay, we can say either we're going to be out of the market with our spot position and not be comfortably back in until we're above it, okay, or we could say, similarly to what I was just talking about, when we are below these moving averages, that's when we're going to be looking to play more of a range. So you can actually see that with this price structure right here, okay, this was such a clean structure, right? So this was textbook, the entire move up. So what we can say is that, for example, when we are going to be applying certain discretion, okay, we might be saying that, all right, we're going to be back in when we are closing above the 14 EMA, okay, but at this point we have to keep in mind how price is going to respond to this structural resistance. So again, we're going to be using a bit of combination of both, right? We want to see that we have the momentum behind us and the trend is in our favor, okay, and then we have to deal with what's ahead of us in terms of supply zone. So this entire way up, you could see how once we fell below the 14 moving average, okay, we would establish this range, and if I go down to the 4-hour, this becomes a bit more clear, all right, and then we have to consider that when we are back off this moving average, we have to still play the same game when it comes to how we are going to meet resistance. Now, generally speaking, we can expect, like I said, where there was a lot of confluence in price action, okay, whether we're talking about, traders relying on weekly closes, daily closes, or just where the confluence exists, all right, on a horizontal line, all right, it's not precise, okay. I see so many people get hung up on how to draw the lines, and that is only applicable in an asset that is extremely liquid. Okay, trust me, I know what I'm talking about. So when we're talking about using both of these in conjunction, all right, we make we make a stronger argument, okay, rather than just trying to, say that when we're above the moving average, we could just assume we're going to make another high. We still have to think about the supply and demand zone in the form of the resistance in that case when we're moving up. So in the recent move where we just kind of had this sustained selling, you still have to, the thing about trading is when you have a method that you trade around, you can't constantly switch it up. So there are people that on Twitter you'll see that they constantly switch their style up. They're constantly looking for that, that way that find a magic bullet, all right? And what they don't realize is their style might have a positive expectancy, but they're just not using it long enough to identify, what that expectancy is. So they're not really giving it a chance to play out. They're not playing the law of large numbers in this case. So we have to understand that there are going to be times when, for example, we have a situation where we have, 15 4-hour bars in a row. And, no one expects that to occur, but we have to still be willing to apply the, same method of trading that we would normally apply. Obviously, when you get better and have more screen time, you'll be able to identify, when a support looks like it's holding or when a resistance looks like it's giving. All right, you'll have a little bit more discretion. Okay, but nevertheless, you still have to apply that same method, okay, and still go about your way as if you are, using that method, meaning you're not going to just switch it up right there. So when the market, starts behaving a different way that you're not accustomed to it behaving, it doesn't mean that you immediately start looking for something else. If you're using structural support and resistance, horizontals, and then, your supports start, letting you down, okay, literally, you don't just start going up to an Ichimoku cloud and trying to find the next best thing that kind of confirms your argument or confirms your bias. So that is my advice to you. I would say find one thing that you can use as a default method to say, okay, this is when conditions are bullish, this is when I want to be out, all right? And the problem that traders have is they get so hung up on, being in Bitcoin the entire time and they don't want to miss out on any of the upside. Now, if you just were in Bitcoin based on a moving average crossover, all right, for the course of history of Bitcoin, you would have been extremely profitable. Now, you could see just through simple methods, right? If we use something like the 20 on a weekly or on a 2-day, I'll just put it up real quick so you can see. So if we use something like the 20, okay, you could see that more or less, all right, there are going to be times when we're out of the market, and yeah, we might miss out on a little bit, but our strategy and our style, rather, in this case, is systematic. All right, we know that we have a clear exit, a clear entry strategy. We don't have to worry about switching it up. We're applying a certain discipline, all right, that is really important for you to apply. And you can see that, you're in the market from all the way here, okay, all the way up here. You have the bulk of that move. You're in from over here, okay, to over here. Okay, you're out of the market or you're shorting when we fall below this on retest. Okay, you could short on the retest because at this point on the higher time frame, when we fall below, we are in a bear market. Now, there's a lot of different definitions for a bull or bear market. Generally, it's the trend is going down or it's going up. This should be clear. We're moving sideways when we're getting accumulated. We're moving up in a bull market. We're moving down in a bear market. But nevertheless, you can see when we close above, sure, we have a mixed signal right here. Okay, we get chopped up. You take losses when you're a trader. You have to be willing to lose. But we're in again here. Okay, we're out again, maybe briefly here, and then back in here, and then, you might get chopped up over here. But you can see, okay, that when you're in, okay, maybe you'll say that it's contingent upon us closing below this. So then you're never really out. You're in this entire move, okay, until here. And you have to imagine it's down here, not up here, because at this point, the moving average is not going to register until price moves below it. So you can see that, yeah, of course, you're not going to get you're not going to get the entire trend, right? But you're going to get 644% here, 356% here, you get chopped up here, you get a 40% move here, all right? As long as you're applying the proper risk management, okay, placing your stops, all right, position sizing properly, okay, you will be or outperform mostly everyone in the long run, okay? Why don't people just use this strategy if it's so easy? All right, because it's more of an investing strategy, and everyone in crypto wants to be Maverick and Top Gun. Okay, they want to be a cowboy. They want to be, I use this term, high speed, low drag. They want to be this gung ho, fast paced trader, hotshot. Okay, when really the easiest stuff that makes the most money is kind of boring because you're not going to be in trades constantly. So this gets back to, why traders are defeated by the market, and it's a lot of it comes down to psychology and self-discipline. So use these methods, all right, see how they work for you. At least you'll have, like I said, you'll have a contingency that or criteria that needs to be met for you to be in the market. You could use it on the 12-hour if you want it to be a little bit more sensitive, right? So we are in when it's above the 20 or the 14, depending on what we're going to use. So you find what moving average looks good to you, okay? Not necessarily just looks good, but you know what I mean. This right here, what I'm giving you is a back-tested strategy. So the 14 and the 20, okay? So 14, all right, and the 20 moving average, okay? This works on the 1 hour time frame, all right, for small trends. Okay, so I'll go down to the 1 hour time frame. You'll see how this works, okay? We are in, out briefly, back in again, okay? The point is that when we do have periods, sure, there will be periods where you get out and then price moves right back up, and yeah, you might be a little late to the party in that sense, but at least you know, okay, that you will be out of the market for the major moves, all right, where we are, if you're not shorting and you're not taking advantage of downside moves, where you're actually, on the sidelines. So you should have some kind of contingency. I don't want to say to trade your spot, but if you're looking to protect your capital, using something like a higher time frame moving average to be in the market or out of the market will have tremendous use case for you. And you might think immediately that you're going to miss out on, the bull run because Bitcoin's going to move up and you might not be in. Trust me, you will outperform 99% of people that are more actively trading. Trust me. If you are not willing to hold and put your money away and take that risk that maybe it all goes to zero, if you're not willing to do that, and you know you can't, this is a question that you have to ask yourself, you should be using something that is a little bit more systematic like this. And then from this, you can use a separate method to identify how you trade the ranges in between. But at least you know this is when I flip short, this is when I flip majority long, okay, or this is when I'm in the market or out of the market. All right, guys, so hopefully that was helpful. If you have any questions, obviously, feel free to ask away. This is Ryan with Block Roots. Exercise proper risk management and trade effectively.